Hi folks, welcome back to our next video, which is going to look at where we left off with the transaction analysis. And now we're going to use some of the data that we have in the transaction analysis template in order to put together our statement of income. So how can we use it? Well, what I went and did, you'll notice along the top here in the assets, liabilities, and shareholders' equity, what you were doing when you created your template is you were creating account names here, right? Well, when we were doing this column here, we were only identifying revenues and expenses, right? That's all we were really doing. So what I went back and did is, in preparation to do my income statement, I thought, well, maybe the best thing to do would be, if I'm identifying something that was revenue related or an R, what would the name of the account be? Rent revenue. If I was indicating anything here that was an R, when I went back to transaction 6, I could see it was a sales revenue transaction, right? If I go back to the E's, I know in this case, in transaction 10, it was they were operating expenses. In 11, the E was related to depreciation expense in the building. So I'm trying to come up with names for these revenue and expense accounts because I need to put them on the statement of income. So what I did is I went down here to the statement. And when I'm doing the statement of income, you'll notice I've got sales revenue. That's the $300,000 that we had that we booked in item number 6, right? And then we had rent revenue that we booked in item number 3, right? So again, I can go back to my template and find these things. There's my rent revenue. There's my sales revenue right here, right? So don't forget, when we were doing the template, we were also identifying that when shareholders' equity was affected, what are the actual accounts? If you go back through that video, we were saying the R is related to rent revenue. Now all I did is type it in, for example, right? I just typed them in here because I needed to put these accounts on my income statement. So it's just the way I like to do it, but you don't have to do it that way. If you know what the accounts are, just plunk them in. The cost of goods sold of $190,000, we identified that in transaction 7. That was the cost of the inventory that we bought, that we eventually sold in item 6. We had depreciation expense. And notice in the depreciation expense, we lumped them together. So we took the depreciation expense here of $71.25 and $57.50. You can do that. You can put them together. Okay, you can put them together. So when we identified these expense accounts as being depreciation expense, even the ones for equipment and ones for building, on the statement of income, it's okay to put them together. We're going to see a little bit later, when we introduce another depreciation type of account, you need to separate them, and that's on the balance sheet. But on the income statement, for the expense side, you can keep them together. So the other expenses that we have is we have interest expense. So what do we do with that little fella? Well, let's go here. You'll notice interest expenses in here. So we've got all of our expenses listed and all of our revenues listed. It is correct practice that we would total our revenues here, get total revenues, and we would get total expenses. And the difference between your total revenues and your total expenses is going to give you your net income or net earnings. So you'll see, just like on this side here, in this little square, all your revenues less your expenses are going to give you net income or retained earnings, right? So now, one thing I wanted to point out to you is also the format, or the fact that we have a 3-line title, the name of the company, the name of the statement, and it's for a period, because don't forget, profit or income is measured over a period of time, not at a point in time. So if I said to you, how much money did you earn at your job throughout the past 6 months? You would be giving me over a period of time, from the beginning to the end of that period, what you earned, and you earned it over time. Same thing with a company. They earn their income over time. They incur expenses and they earn revenue over a period of time. Okay, so it has to be for a year, which is what we have here, for a year, because we know we've gone from January, the beginning of the year, in this company, right to the end of the year. So it's for a year. All right. So now that we've got the income statement down, now we're going to look at the statement of changes in equity. And this is a statement that was introduced in this chapter. And the statement of changes in equity just looks at all of the shareholders' equity accounts. The only ones you've had so far, if you look at our question, you had common shares at the top, right? Your shareholders' equity had common shares and retained earnings. We're going to talk a little bit about dividends declared in a moment, all right? So now what you've got is you've got your share capital, common shares, and your retained earnings. Well, at the beginning of the year, retained earnings was 0, and we didn't have, any common shares until we issued some during the year. On January the 1st, we issued 3,000, right? We also issued 150,000 later on in the year. So you remember the $300,000 worth of common shares were issued January the 1st, and then we issued some more shares. And if you remember, we issued those shares on January the 1st when we bought the land and the building, right? That was for 150,000. So we have a balance at the end of the year in common shares, dollar value of common shares of 450,000. Now you'll notice related to that, they have a column for the number of common shares. And I guess the best way to explain that at this point, given the fact that we're not at the balance sheet yet, is that companies do need to track how many common shares are actually in the hands of shareholders, right? So you'll notice that if you look at financial statements and you're looking in the equity section, they will usually tell you how many shares the company actually has issued to shareholders. They'll either do it on the face of the statement or they'll do it in the notes to the financial statements, but they do tell you. So here what we do is we put it right in the statement of changes in equity. So we say this is the number of common shares that were issued when we got our $300,000 on January the 1st. And then this is the number of common shares that were issued when we bought the land and the building, right? The 6,000 shares. So we have $450,000 worth of shares out there, okay? And there's 18,000 shares. During the year, what else did we do? Now we're going to look at the opening to ending balance of retained earnings. Well, don't forget, A.J. Smith was a new company. They just started business this year, so they didn't have any retained earnings to open the period. But what affects retained earnings? Well, we keep going back to this little picture. Retained earnings is affected by net income less the dividends that are declared, not the dividends paid, the dividends declared, right? Which is all of them in our case. And that's going to give you the ending balance of retained earnings. So if we go back here, we know that we had income of $66,625. We calculated that up here. And we know from the question, they told us that we declared dividends of $20,000. So we have $46,625 in retained earnings. So the total dollar value of common shares and the total dollar value of retained earnings should give us the total shareholders' equity. And this is the number that would appear, this $496,625. This is the number that would appear on our balance sheet, or statement of financial position as they call it. All we normally do in the statement of changes in equity is we not only total all the columns that make it up, we also do a row total. So you'll notice here we're totaling the rows as well, and that's how we are reconciling. So we know that our column totals should give us our total shareholders equity balance on the balance sheet, but we also know that if we add across row by row and then add up all the row totals here that I'm highlighting, okay, so the 0, which is your opening, the 66,625, the 20,000 here, okay, over here, and then the 300,000 over here, as well as the 150. If we add all those up, we're going to get 496,625. So we normally do a total of the columns and a total of the rows, just to make sure that as we converge down this way and across this way, we get the same number. And this number is going to be on your balance sheet. Okay? Now, one thing I want to mention now that we've done the statement of changes in equity in the income statement, not often, but sometimes I see students sticking dividends declared or even dividends paid as an expense. Remember one thing, and if you think about it this way, it makes sense. Your shareholders, who are the people that finance your business, cannot be people that are a cost to your business. It doesn't make sense. If I'm giving you money to operate your business or to help you run your business, how can I be a cost? So often say to students when I'm teaching in the classroom, your shareholders wouldn't be happy if they thought you were recording the dividends as an expense, because it doesn't make sense at this level to consider it an expense. It's really, the dividends are really a return to the shareholders of what you earned in your business, right? So if they financed your business, they have the right to get some return from it, right? That's why they're investors. They want to make money on their money. So it's not a cost of running your business. So dividends are not an expense. And sometimes I think students think it is because they see it in the template lumped with revenues and expenses. So they think, oh, well, DD, dividends declared, it's got to be an expense. But it's not. And that's one of the reasons why we've separated it out here. It's not an expense. Okay? It goes in your statement of changes in equity. All right? So now let's go to the balance sheet. So the last thing we're going to look at here is the balance sheet. And guess what? If you remember what I told you in one of the earlier videos, we said that total assets total $617,125. That should sound familiar to you. That's the total assets that we had when we did the template. So that's the advantage of adding up the column totals. Remember here I said you didn't have to do it, but it would be nice if you did, because these are your column totals that are going to go in your balance sheet, right? So this is your cash, this is your accounts receivable, this column here was your inventory, your land, your building, and then your last column here was your equipment, right? So it's a good idea, I think, to put that stuff in, you know where it goes, right? You know, when you got this, you know exactly what your total assets are, and you know what the balance in each asset account is. Similarly here, you know that accounts payable is $45,000, you know that your unearned revenue is $7,500, and so on. And again, we also know what our total shareholders' equity is down here. So if we now go to our balance sheet, all I'm doing is going to my template, and I'm picking up all the numbers. Notice two things. Number one, notice the statement is for A.J. Smith. We name the statement of financial position, also known as the balance sheet, but it's at a date, or as at December 31st. So this gives us the balance of each account on the balance sheet at one point in time at December 31st, right? So an income statement shows you income earned over a period of time. So the third line in the three-line title will say for a year ended, for, or maybe for a month ended, depending on how or what the length of the period is over which we're collecting revenue and expense data. In our question, it just happened to be a year. But the idea is the balance sheet shows you balances at one point in time, but the income statement or statement of income shows you balances that were earned, revenues earned and expenses incurred over a period of time. So that's important, all right? But again, notice that the assets go first, right? And the assets, remember they said to prepare an unclassified balance sheet? Well, you'll notice in your textbook they have shown you examples of classified ones where they separate current and non-current assets and current and non-current liabilities. But we didn't do that because they asked us to produce a non-classified or unclassified one. But there still is an order. Notice you've got cash first, then accounts receivable. Cash and accounts receivable are known as what we call liquid assets. Liquid assets are those that are most readily convertible to cash, and there's nothing more like cash than cash, so it always goes first. Receivables, when they're liquidated, i.e. when your customers pay you, you get cash, right? But when inventory is liquidated, right, when you lose your inventory, you don't normally get cash right away, do you? You sell it to customers, so when you sell inventory to customers, you sell it on credit, and you get a receivable, right? So it's the receivable that's liquidated or that's being paid once the inventory is sold. So things like inventory, land, building, equipment, they're not as liquid. So in other words, we don't really know how much cash we're going to get for those things when we sell them. So, but we do know what cash is. It has a very objective value, right? And receivables, we know exactly what we're going to get when our customers pay us, right? We know what they owe us, right? So we have the order of liquidity here. So the most liquid assets are cash and receivables. With the liabilities, there isn't really an order in an unclassified balance sheet. There's an accepted order. So the accepted order has always been accounts payable first, and then all of your items for which you might make adjusting entries. And we'll talk a little bit more about adjustments when we get to chapter 3, but they did introduce it in chapter 2 as well. But the idea is that, the accounts payable normally go first. You could have put interest payable before notes payable if you wanted to. You could have put dividends payable first. There is really no definitive order with the liabilities. And then with your shareholders' equity, yes, there is an order that we have. Your share capital goes first. In this case, we only had common shares as share capital and retained earnings. So notice that our total assets of 617,125 equal total liabilities plus total shareholders' equity, which is 496,625. So I noticed here they got total retained earnings. It should be total shareholders' equity to me. That's what it should be. So I would put it in like that, because that is your total shareholders' equity, the total of your common shares and your retained earnings. So when you add that to your total liabilities, you're going to get a balance sheet that's in balance. All right? And remember, I told you, as long as every transaction, when you put it in the template, the balance sheet equation is preserved, meaning it stays in balance, you should get a balance sheet that balances, right? And we did. So now, the last thing we're going to look at here is the cash flow statement for A.J. Smith. Now, notice there is an order to the cash flow statement. But first of all, notice the 3-line title. We're looking at the opening balance of cash and comparing it to the ending balance. So the cash flow statement answers the question, where did cash come from during the year? And where did cash get used up during the year? So we call it sources of cash and uses of cash over a period of time. So it's for the year ended. So it's kind of like the income statement or statement of income that way. It's for a period. And there is an order. It's operating, investing, and financing activities. So let's look at all the cash that flowed into the company and flowed out of the company from operating activities. That's first. Then from investing activities, that's second. And then from financing activities, that's third. I say to students sometimes when I'm in the classroom, just remember OIF, O-I-F, OIF, the acronym. So if you're doing a cash flow statement, that's all you got to know. The order, OIF. But now think about what goes in each of these sections. Well, what are some kinds of things that are operating activities? Well, in the textbook, they gave you some examples. Anything that's normal in the course of business. So things like customers paying you, right? Things like you paying suppliers. So when you pay down your accounts payable, what would happen? You use cash. So that's a use of cash. When customers pay you, they're paying down accounts receivable, or maybe it's a cash sale, but cash is coming in, right? So that's a receipt of cash, those kinds of things. So if we looked at everything that we got cash from that we consider to be an operating activity, like from customers, including our tenant here, who was Fantech, so that's an operating activity, the fact that we're renting out some of our space. We paid for our inventory. Well, when you pay for things that you buy in a business, that's an operating expense. And then we had other operating expenses as well. So notice that we use brackets around these to indicate that cash is flowing out of the business, or we're paying cash out. and we don't put anything around when cash is coming in. So at net, we have net inflow from our operating activities of $25,000. What kinds of things would be investing activities? Well, investing activities would be things like buying capital assets. Capital assets are things like, those are the depreciable assets. Building, equipment, vehicles, those kinds of things. Now, things like land would also be a capital asset, but it's just not depreciable, right? So we don't differentiate in the cash flow statement those assets that are depreciable and not depreciable if they're capital, but we do differentiate them on the balance sheet because some are depreciated and some are not. But on the cash flow statement, we bought a whole whack of capital assets, so whether they're depreciable or not, we're just saying, hey, we paid $140,000 to buy them. So that was our cash outflow. All right, $140,000. So if you're not sure where any of these numbers come from, you can certainly go back to the template, right? Go back to the template. So let's go back here and look at what we had in terms of capital assets. If you're not sure, if you don't remember, you'll remember that we paid $80,000 on January the 1st, right? And then we bought equipment and we paid $60,000 in cash. So this $80,000 here was for the purchase of our land and building, and then we had a $60,000 decrease in cash when we bought our equipment. So there's your two cash flow items. So that's, you'd have to go back and do a little bit of digging and think it through, but you can also get it from your template. So your template is supposed to be right, and if you do it right, all your stuff will flow through in your statements from your little template, right? So we didn't sell any capital assets. Normally when you sell capital assets, what would happen? You would get money for them. So if you sold a car, you sold your house, you'd get money for it, right? Same thing with a company. If they sold a building or they sold land, they get money for it. But they didn't do that. So everything is an outflow, hence a bracket, right? So that's your $80,000 that you spent for land and building and your $60,000 that you spent for equipment. So it's a net cash outflow of $140,000. Now we have our financing activities, the F in OIF. So where are those? Financing activities are things that, if you had to borrow money, right? You got a bank loan. That's money coming into the company and you got the loan to finance your business. When you issue shares to investors, the investors give you money, right? Well, that's a source of cash for you from financing because your investors are financing your business, right? When you pay dividends, because we consider the money coming in when people buy our shares as a financing inflow of cash, then we consider any dividends paid back to those investors as a financing outflow. So that's why you have the $300,000 that you got when you issued shares, right? And when did we issue shares? We issued shares on January the 1st, right? 300,000, I think we had $150,000 there. Or did we have more? Let me just go back and check. When we issued the shares, let's go back up here into our little template, right? Yeah, we had 300,000 in common shares, right? That we had. And then, just going to pause this for a sec. Okay, notice that in your cash flow statement, even though the common shares for 150,000 were issued, we don't have it in our cash flow statement. And think about why. We issued $150,000 in shares and we spent $80,000 in cash. But what did we get? We got land in a building. We didn't get cash. So the idea is when we issued the shares here, the $300,000 worth, we got cash. So by definition, the fact that we issued the shares affects cash flow because cash came in when the shares were issued. But when these shares were issued, cash didn't come in. What came in? Land in a building. That's what we got, right? So the idea is if you're not getting cash in when you issue common shares, then it's not a cash flow item. Okay, so that's why we don't have the 150,000 in there, right? So we're only looking at items, sorry, I'm scrolling here, but I have to with this question. We're only looking at shares that were issued whereby cash came in. But when we issued the 150,000 in shares on January the 1st, when we bought the land and building, there was no cash that came in, so we don't have that there. We do have the dividends. Now notice here, it's not the dividends declared. It's the dividends paid. And in our example, these authors were tricky. They said, we're going to see if the student puts in the dividends declared here in the cash flow or if they just put the dividends that were paid. Because it's cash flow, we're looking at how much did you pay out in dividends? And that's only 15,000, because remember, of the 20,000 declared, 5,000 were going to be paid later and 15,000 were paid this year. So that gives us a net inflow of cash of 285. So now don't forget what I said. We're looking at the net cash brought in from operating activities, the net cash spent from investing activities, and the net cash inflow from financing activities, O, I, and F. And in total, if we add these three guys up, what do we get? We get 170,000 as our increase in cash, which makes sense. Why? Because you started off with nothing. You got 170,000 in, and it makes good sense to me that that's my ending cash balance. Why should it be? Go back to your template. Again, the advantage of summing all the columns. Because you already knew that you should have 170,000 in cash, even in your ending cash flow line, because that's the ending balance. So you can also use this as a check to determine not just how much cash goes on the balance sheet here, right on your balance sheet, but also to determine what your ending cash balance is. So this should tie in. So the total in your column for cash in your template should tie into the cash balance in your statement of financial position or balance sheet, and also tie in your cash flow statement to the ending balance in the cash flow statement, right? So, I'm not sure if you have any questions. If you do have any questions on the video, feel free to post them in the Chapter 1 discussion board. Start a new thread. Don't put it in Applying Course Concepts. Start a new thread, okay? And pose your questions if you have anything or I should say Chapter 2, really, because it is related to Chapter 2. Or, whatever. If you want to email me privately, you can if you have any questions on the video. But hopefully it's made some sense to you. Now what I'm going to do is I'm going to look at, in Chapter 3, I'm going to do a video on a question that builds on this content. So it gives you back some of the transactions that we've analyzed in the template. But now what we're going to do is we're going to make those debit and credit journal entries. That's the topic, a big topic in Chapter 3. So we're going to use all the same data and then a little bit of new data. And now for all the things we put in the template, we're going to build on it and say, now how do we take these financial transactions that are in the template and make journal entries? Because it's the journal entries that we actually record as debits and credits in our financial records. All right. So this concludes our video on problem 2-34, and now we're going to do one related to Chapter 3. Okay. So you can be looking for that. So I hope you found the video series helpful for this problem, and if not, let me know if you have any questions.